Hello and welcome to today's session. I am Dr. Sheila Bijilwan, Assistant Professor at Swami Rama Himalayan University, and in this lecture we are going to explore a very important topic in the Indian financial system, that is the role of RBI in regulating the money market. The money market play an essential role in the functioning of the economy, especially in terms of liquidity management, short-term fund mobilization and implementing monetary policy effectively. The Reserve Bank of India, being the apex monetary authority of the country, assumes a central role in the regulation, development and a smooth functioning of the money market. To begin with, we need to understand what the money market is and how it differs from other segments of the financial system. The money market refers to a segment of the financial market where short-term instruments with high liquidity and short maturity periods are traded. These instruments are typically those with maturity of up to 1 year, such as treasury bill, commercial paper, certificate of deposit, call money and notice money, and repos. The money market serves as a crucial link between the Reserve Bank of India and the various financial institutions in our country, helping to transmit monetary policy significantly and effectively. The Reserve Bank of India, or RBI, was established in 1935 and has since evolved into a powerful institution overseeing monetary policy, powerful currency, insurance, issuance and regulation of bank and financial market. As far as the money market is concerned, the RBI acts as a regulatory facilitator and participant. It monitors and regulates the availability of liquidity, the interest rate structure and the orderly development of the money market instrument. Through its monetary policy tools, the RBI ensures that inflation is kept in check while promoting growth and financial stability. One of the key responsibilities of the RBI in the money market is liquidity management. The central bank manages to liquidity through various direct and indirect instruments. One of the most important instrument is the repo and reserve repo operations. In a repo operation, the RBI lends funds to bank against government security, thereby injecting liquidity into the system. On the other hand, in the reverse repo operation, the RBI absorbs liquidity by borrowing from banks and offering government securities as collateral. These operations influence short-term interest rate and help manages temporary liquidity mismatching in the financial system. Another critical tool used by the RBI is the Liquidity Adjustment Facility, commonly referred to as the LAF. The LAF was introduced in the year 2000 to manage day-to-day liquidity mismatches and transmit money to policy signals to the market under the facility. The RBI conducts repo and reverse repo operation on a daily basis. This has become the most important instrument for short-term liquidity management and interest rate signaling in the Indian money market. Apart from the LAF, the RBI also uses the Marginal Standing Facility (MSF), which allow scheduled commercial banks to borrow funds oversights from the RBI against approved government security. This facility was introduced to provide a safety valve against unanticipatory liquidity shock, and it's typically used by banks where they face acute liquidity shortage. The MSF rate is generally higher than the repo rate and act as a cooling for the interest rate in the money market. The cash reserve ratio or CRR and the statutory liquidity ratio or SLR are other powerful tools at the RBI disposal for regulating liquidity in the monetary market. The CRR is the minimum percentage of a bank total deposit that must be held in reserve in the form of cash with the RBI. By altering the CRR, the RBI can enter, inject or absorb liquidity from the banking system. A higher CRR means banks have less money to lend, thereby tightening liquidity, while a lower CRR increasing liquidity in the system. Similarly, the SLR mandate that bank must maintain a certain percentage of its net demand and time liability in the form of liquid asset like government bonds and gold. By adjusting the SLR, the RBI can control the availability of funds with banks for lending purpose and thereby influence money market conditions. The RBI also engage in open market operation, which involves the buying and selling of government security in the open market. These operations are aimed at regulating the money supply in the economy. When the RBI sells security, it absorbs liquidity from the market, and when it buys security, it injects liquidity. Open market operations and are thus a powerful tool in the hands of the RBI for managing inflation and maintaining price stability. Another significant function of the RBI in the money market is settling benchmark interest rate. The repo rates, which is the rate at which the RBI lends to commercial banks, serves the policy rate that influence other short-term interest rate in the economy. Changes in the repo rate directly affect borrowing cost for bank, which in turn influence the interest rate of loan deposit. Therefore, the repo rates become a crucial level for the RBI to control inflation and support economic growth. In addition to these tools, the RBI also regulate and develop the institutional infrastructure for the money market. It has played an important role in the development of various money market instruments and in the establishment of institutions like the Clearing Corporation of India Limited, well known as CCIL, which ensure a smooth settlement of money market transactions. The RBI also coordinate with other regulators, the SEBI and the IRDI, to maintain overdraft financial stability. The call money market, which is a vital component of the money market, is also under the regulatory purview of the RBI. The call money market deals with the overnight loan between banks and other financial institutions. The RBI regulates the call money market by monitoring the interest rate and ensuring the adequate liquidity is maintained to facilitate the interbank borrowing. In times of volatility, the RBI investment in the call money market to prevent instability. The RBI also monitors two certificate of deposit and the commercial paper, market certificate of deposit and short-term time deposit issued by the bank, and the commercial paper are unsecured short-term promissory notes issued by the companies. Both are important instruments for short-term fund raising. The RBI presume guidelines for issuance, eligibility rating requirement and disclosure norm for these instruments to ensure transparency and investor protection. Another emerging area where the RBI is actively involved is the development and regulation of the repo and reserve repo market in government security. These markets help in better liquidity management and deepen the secondary market for government security. The RBI ensures that these transactions are carried out in the transparent and efficient manner. In addition to regulating the existing money market instrument, the RBI is also instrumental in introducing new instruments and improving the technology framework of the money market. With the advancement of digital platform and electronic trading system, the RBI has encouraged the adoption of electronic dealing platform, real-time gross settlement system and automated clearing system. This initiative has enhanced transparency, efficiency and participation in the money market. Furthermore, the RBI play a crucial role in the development over the years. The RBI has taken initiative to develop the money market by encouraging broader participation from various market players, including mutual fund, insurance company, primary dealer and non-banking financial companies. By allowing greater participation, the RBI has improved the liquidity and depth of the money market. The role of RBI in ensuring stability in the money market was particularly evident during the time of crisis. For example, during the global financial crisis of 2008 and more recently during the COVID-19 pandemic, the RBI introduced several unconventional measures such as long-term repo operation, targeted LTRO and specified liquidity facility to support a specific sector. These measures helped in easing liquidity, asset and ensuring credit flow to the economy. The RBI also continuously revised and updated the regulatory framework in response to emerging risk, market development and international best practices. Through its financial stability report and monetary policy settlement, the RBI communication its assessment of the market and outline in regulatory stances. These communications help in guiding market expectations and reducing uncertainty. In conclusion, the RBI play a multidimensional role in regulating the money market. It functions as a policymaker, regulator, facilitator and developer. Through a combination of monetary policy instrument, liquidity operation, market intervention and developmental initiative, the RBI ensure the smooth functioning of the money market. This not only aids in effective transmission of monetary policy but also support broader macroeconomic objective, the inflation control, financial stability and economic growth. The regulation of the monetary market by the RBI is the continuous and evolving process with the increasing complexity of financial market and the growing complexity and integration of domestic and international market. The RBI role is becoming even more crucial by ensuring transparency, efficiency and stability in the money market. The RBI contribute significantly to the resilience and vibrance of the Indian financial system. As we reflect on the various phases of the RBI involvement in the money market, it is clear that the strong and effective central bank is important for the health of the financial system. The RBI proactive approach, timely intervention and commitment to innovation and development have positioned it as a credible and respected institution not only in India but globally. Its continuous engagement with the stakeholder responsiveness to market development and focus on systematic stability underscore the pivotal role that plays in the Indian economy. Now, thank you for staying with me for the detailed evaluation of the RBI role, monetary market regulation. I hope this lecture has provided you with important insight and the functioning of financial system and the critical role of our financial system in the development of our economy. The RBI and its role is very important. Now we will meet in the next lecture. Thank you.